Hey, party people. Hope you're well. Here today, bringing you another episode of Money News in Human Words, helping you understand the key stories that you need to be across and what they actually mean for your money and for your investments. There's a lot of stuff going on at the moment with money. Markets up. The share market last week was wild. Finished the week up 3% on the NASDAQ, basically unheard of, sort of massive jumps day in and day out. Thankfully, ended the week a little bit up, which is some welcome news for investors. There's also a ton going on in the economy between what's happening with the government, what's happening with interest rates, inflation, and the property market, and all those things. So I want to unpack the key things that you need to know. First thing that I wanted to cover was around the share market being in the crosshairs in the battle against inflation, and was reading an interesting piece around the fact that the Federal Reserve in America obviously is as basically one of the biggest investment markets, or the biggest investment market in the world, but as well as the RBA closer to home have basically said that they've a lot of commentary about the fact that they've left it a bit long for increasing interest rates. Inflation has gotten a little bit of a life of its own, and now, in order to have the outcome or the achieve the same results that they want, they're going to need to raise interest rates faster, further and faster than what they had anticipated. And the Fed in particular have come out specifically saying that they're not concerned about the impact on share markets because the economic risk is more important. And look, I would tend to agree with them on that. However, obviously that's worrying for investors that are looking to make a few bucks and not sort of cost themselves too much in terms of the gains that they might have made over the last little bit. So markets in the US are expected for interest rates to go from 1% to 3% by the end of the year, but actually could go to 4 or 5% potentially as well. And with some of the issues that we're seeing with supply chains, the Russia conflict, petrol prices, oil prices, could actually, like, they're having an impact of making inflation worse. And it's something that's out of the control of the Federal Reserve or central banks. Historically, they would just jack up interest rates, and then inflation would come right down. But because these things are out of their control, it means that inflation could be running faster, and a bit of a worry. So what do you actually do about this? Look, talking to a lot of investors that are really used to just seeing the market going up, we tend to have short-term memories. And really, for the last 5 years, with the exception of the blip of COVID, we've seen markets on the rise. Talking to a lot of people as well that are really investing more, like this last 5 years has been a period where they're really investing the most that they've ever done before. And that means that, when we're seeing like the declines that we've seen over the course of this year, can be quite worrying. So it is, I suppose, a reminder and highlights the fact that it's more important now than ever before that you want to really be rock solid when it comes to your investment game plan, so you can avoid that noise, get on with what you want or need to be doing, so that you can get the results that you want. Another interesting thing that I've been looking at over the last week is around tightening to the higher risk lending from the big banks in Australia. Basically, that big banks like ANZ and NAB used to consider applications from customers that you could basically borrow up to 9 times your salary. So if you're on an annual salary of, say, $200,000 every year, you could borrow up to $1.8 million. But this week, both ANZ and NAB have come out and said that they're going to tighten the lending for these customers, and will not be considering lending for any customers that have debt to income ratios higher than 7.5, which means that basically the borrowing capacity for that someone on $200,000 income that I just mentioned is reduced to $1.5 million. So that's $300,000 less that you can borrow, which could impact your ability to, say, buy another property. But I think it's particularly relevant for people that we're seeing 40% of mortgages at the moment are currently fixed. And so when those fixed terms expire, it's going to mean that some customers are really locked in with wherever they are, because they're not going to have the same number of options if they could go and shop around in the market. For the last little bit, money's been pretty free and easy. And so it meant that for individuals that you had a lot of choice, the rates could get lower. And if you don't have that choice, then you have to suck up a higher rate, can seriously impact cash flow and then have a slowing down effect, which probably helps with the inflation issue that we're seeing at the moment. But it's worrying news for people that are in that spot where they're getting sort of close to those debt ceilings. So I think that it's particularly relevant for people that are already in the market, people that have fixed interest rates, or for people that are looking to grow wealth through property. And as we know, property is an incredibly effective way to grow your wealth because of the fact that you do borrow to invest. So the main driver of this, as a bit of an FYI, is the increase to interest rates, because the banks are worried that when your borrowing levels are higher multiples of your salary, when there is an increase to interest rates, it does have more of an impact. So the actions from here, look at your banks. If it makes sense to make a move, probably look to do that sooner, because it's likely that a number of other banks will follow suit and you could be left out in the cold. Another thing that I think is important for people to be across at the moment is the inflation rise, giving big tech more power, in particular the biggest tech players. Now, they're basically, we've seen over the last little bit that we've this huge tech boom where all of these tech companies have got massive amounts of funding. Sharemarket's been on the way up. Getting funding hasn't been an issue for companies that had good business models. But in the current economic climate, a lot of that funding is drying up. We're already seeing that with some companies that have struggled to raise with what's going on at the minute. Other companies even companies that have raised really well, think of companies like Canva. We saw Dovetail come out and do a massive raise, like a whole bunch of different businesses that could potentially struggle. And we're seeing these tech companies being forced to really look at their P&L and their expenses and trim a bit of fat, which they're not used to having to do. And certainly we haven't seen this for the last few years. So what that can potentially do is drag down on the growth and further contribute to the difficulty for tech companies in raising capital. What that means is that for the biggest companies, the biggest tech players out there, Facebook, Amazon, Apple, Google, Microsoft, the ones that are well-funded, got huge operations, that it probably gives them more power and dominance in the current market, means that they can compete for staff. They've got huge amounts of cash on their balance sheet, which means that they're potentially in a better position to ride out the market downturns that we might be seeing over the next little bit. So what it also means is for investors that potentially we're going to see a bit of a splitting of the market, where you're seeing the big tech players performing better and the not so big tech players struggling a little bit more. For people that have employer share plans, it's also something that's likely to have a huge impact on wealth building over the next little bit. And I think it really highlights the importance of having a solid strategy and game plan around that. We're unfortunately talking to a lot of people at the moment that are being caught short with some of the tech share market declines and really paying the price, where you've got shares vesting, tax bills accumulating, share price going down, shares being worth less, facing really difficult decisions on what to do. There's no one right approach here, and I think there's a lot of different ways to be right. But if you don't have a clear plan, you get caught in the wrong spot at the wrong time, can be really stressful, and it can be a big drag on your ability to create wealth and build your assets over time. So I think highlights the importance of making sure that you're on top of your strategy there and making the right moves for you. Also, for anyone that's working in tech and thinking about potentially changing jobs, probably a good time to look at that now before whatever's happening in the economy sort of sets in too far, and thinking about, the size of the company that you're working in and what that means for the benefits that you might get, the stability that you get around your job over the next little bit. Another interesting thing that I was looking at in the news over the last week was around the businesses bracing for the Labor government. Interestingly, they unpack some of the data around what the average share market return is under a Labor government compared to a Liberal government. I was looking at, the numbers from 1945, basically, that while Labor's been in power, the share market has returned an average of 10% per annum, whereas when coalition governments have been in power, it's been 12.9%. So a big variance. But looking at the most recent past, and I think there's a bit of unfortunate timing around this, but the last time that Labor was in power for 6 years, the share market returned only an average of negative 0.4%. So I've got my fingers crossed that isn't what happens over the next 6 years if Labor remain in power for that amount of time. But I think, again, important for investors to understand the impact. We have seen some of the policies come out that can potentially have a drag down effect on business. Again, I think Labor are coming into it at a really difficult time where we've seen this inflation going up. We've just seen this big rise in the share market and property market. So obviously they're not taking all the blame or the credit, I suppose, either way with that, nor should they. But I think for investors, when you've got clear targets and goals in mind or things that you're trying to achieve, then you want to just be mindful of the broader economic conditions and what that means for your goals. Now, we've seen the Labor government prior to the election, Albo's come out backing in the increases in minimum wage, which is pretty unprecedented for a prime minister or potential prime minister to be telling, the wage indexation rates need to be higher. Not that I disagree with the sentiment given the inflation that we're seeing, but potentially that's something, and that sort of intervention into markets can have a drag down effect on businesses. Thankfully, we're seeing some of the labor shortages naturally balancing out the wage stagnation, I suppose, where because there are such skill shortages in different pockets and different industries, there's more demand, and that's having the impact of pushing up wages in those particular sectors. So hopefully that helps to balance out some of the need for government intervention, and things can just naturally right their course. One other piece that I was looking at, which I thought was super interesting over the weekend, they were looking at the suburbs that had been trading for real estate, trading at discounts to the listing prices. Basically, they looked at all of the property sales ex auction. So it does cut out a little bit of the market there, but they looked at properties that were the sale price of properties relative to the initial listing price. And they found a bunch of suburbs and across the market, I suppose, generally, that properties selling for a significant discount to what they initially listed for. Cogra Rockdale area was the suburb area with the biggest discounts at just over 10%. The next biggest one, though, was Mossman, North Sydney, where we're seeing discounts of 8% from the listing prices on average that properties are selling for. So I think that the drivers of this is really higher numbers of listings, people trying to sell and get out of properties prior to the property market declining further and interest rates increasing further. But what it means is that you could potentially pick up a discount, especially if property is something that's on your radar or that is the next move for you. You're getting a 10% discount to what probably seemed like a maybe unachievable, but the realistic price over the last little bit. So it means that those premium suburbs are really coming back into reach, or premium properties within suburbs are coming back into reach for buyers as well. Worth taking the time to follow along. And I think that the actions on this one is really you want to know your market. I talk to a lot of property expert property buyers agents, and the big advantage that they have over normal buyers and sellers like you and I is the fact that they're in the markets every day, that they're seeing all of the properties that are selling all of the time. So if you're wanting to make a move, particularly important to make sure that you've got, you're clear on the numbers and you've got the right strategy in place with what's going on at the moment. But if the stars align for you on this, that you want to be in the market day in and day out, looking at what properties are selling, what properties aren't selling, what they're selling or not selling for, that's going to give you a good sense of what numbers actually make sense, so that you can pull the trigger on a property purchase and do that with a lot of confidence, knowing that you got the right numbers behind you. I think particularly with all of the noise out there at the moment in markets and in the media, that you really want to have that confidence, because otherwise it's going to be really scary and it could potentially become a roadblock to you actually executing and starting to get the results. My take, always a lot of fear in markets are when the interest rates are increasing, but we're still strong population growth and limited supply for quality suburbs in Australia. So I think property prices will be supported over the medium term. No doubt we're seeing a structural change with COVID and that sort of stuff, but still a big important step on your wealth building journey. So something that if the market conditions turn in your favor, you can take advantage and accelerate things for you. My last piece for this week was around scary interest rate predictions off the back of some of this inflation data. We're just seeing the big banks come out and they're a bit of a variance in terms of how far they think interest rates will go in Australia. But ANZ is predicting 3% cash rate by the end of the year. So potentially a pretty substantial jump from where things are now. And one of the big drivers of this was some data that showed that according to Reserve Bank of Australia data, that 40% of borrowers on a variable rate would see no changes to their mortgage payments if the cash rate was to rise to 2.1%. What that means is that if people aren't seeing changes to their payments, that the Reserve Bank is not having the impact that they want. And the reason the Reserve Bank is increasing interest rates is to make sure that people have less money in their take-home pay so that they spend less money so that inflation goes down. But if we're seeing a situation where the interest rates aren't having that impact, they're not slowing down inflation, they're not making people have less money in their banks at the end of the week or month, it means that the RBA needs to do more. So potentially the rates are going to have to go up further. That creates an impact on individuals, obviously, with your cash flow and how much money you have left over, but it also creates some economy-wide risk. So I think what to do here, really, you want to look at whether fixing rates make sense to you, and look at this in two ways. You want to look at what if you've got a variable rate and the cost of that variable rate increases significantly over time. Can you afford it? Because you could look at a fixed rate and say, well, maybe I can't afford that, but if you're going to be under tons of pressure with the variable rate, potentially it's better to make the move now while you've actually got the option than when you're backed into a corner and can't get out. So look at what happens if the variable rate increases. Look at what the fixed cost would be right now. And that's important as well because fixed rates are higher than variable rates at the moment. So fixing your rate might give you some certainty, but it is going to lock in costs. So you want to be really careful of that. Look at how that's going to impact your situation today, tomorrow, next month, but also a year from now and 3 years from now with the other things that might be changing in your spending and lifestyle plan, kids in school, childcare costs, time out of the workforce, all those sorts of things. You want to make sure that your borrowing repayments fit neatly in with all of that so that you can make sure that you're making the right decisions, not only for today, but for the lifestyle that you want to live in the years ahead. Guys, I hope